2023 has been a pretty crazy year, but I think now it's time to start thinking about 2024. I'd say most of you are going to be taking this time off between now and the new year. If you're not, you're crazy. And so starting to get into the mode of, okay, what does the next 3, 6, 9, and 12 months look like? So a couple of themes that we're going to have to focus on really are to do with inflation coming way, way back down and whether there's a possibility of deflation coming into the market. We're going to have to be thinking, therefore, of rate cuts rather than rate hikes and what the resultant outcome might be on risk assets, bonds, and things like that. We're going to have to start thinking heavily about the geopolitical situations, both socioeconomic, conflict-wise, and also how allyships are forming across the world. Again, debt is going to remain a massive, massive problem because the last 3 years has invoked massive expansions of sovereign debt and government spending. So how are governments going to be reining this back in? And I think starting from these points of view now over the next couple of weeks, I guess, in terms of planning what your outlook for the economy looks like, doesn't just help you from a trading sense, but it allows you to build a better perspective of the world and how you understand things as well. So a couple of the key points that I'm looking at is definitely the deflation story. I think even the UK CPI that came out today, that's 3.9%. It was well under the expected. And this is where we are headed now. We're headed on a very downward trajectory in terms of that inflation story. When you start hearing that, you should start hearing, okay, well, that sounds like bonds need to go up because interest rates are going to come down more. And, the resultant effect of the inflation print today in the UK, for example, was that cuts started to get priced in for May. There's an 80% chance of the Bank of England to cut in May. When we're talking about allyship, it probably invokes the, story that you might have heard recently of multipolarity, which is kind of the relationship between China, Russia, Iran, etc., versus the US and a lot of the rest of the world. Will that story kick up? Will people become more insular on those terms? All relevant things to think about when it comes to commodities like oil, the metals, iron, etc., etc. So again, something really, really key to focus on. And especially at a time now where shipping lanes are even being disrupted over in the Suez Canal over the war between Israel, Palestine, Yemen. And effectively, it's turned into a proxy war from, the US versus Iran. When we're talking about rate cuts as well, I like to re-emphasize the fact that everything is relative. So just because rate cuts are occurring doesn't mean that, asset prices won't keep going up. It doesn't mean that things are all okay just because rate cuts are causing easing. Various different effects can happen because what we're looking at always is asset prices on a relative basis to other asset prices and interest rates. And a barometer of interest rates, of course, is bond yields. So making sure that we have a strong focus on bond yields at the front part of this year is going to be very key. As a result of this, I want you to be focusing on what volatility looks like, because if volatility in the bond market starts picking up, there's a big trade that I mentioned a couple of weeks ago called the basis trade that could really cause some issues for hedge funds and central bankers. I think going into 2024, the banks are still relatively safe. They've got a lot of capital buffers that are causing them to not have to panic so much. We did have the hiccups with Credit Suisse and Silicon Valley Bank, but there's still so much liquidity in the economy that I don't think that these things are going to cause issues. So if you start hearing about people talking about banks blowing up, I would say ignore them. The big thing that could blow up, though, is if unemployment starts to tick up, because we've got a lot of revolving credit out there. We've got a hell of a lot of revolving credit on credit cards, on different credit facilities via other banks. So personal credit could become an issue. However, it's nowhere near that 2008 level. This could be hidden through car loans, though. So the car market is very, very cooked. and there could be a lot of defaults in the car market. But overall, I think 2024 is going to be a story of lower inflation, decreasing inflation at least. It's not necessarily going to be a story of a lower price level, though. Remember, there's a difference between price level and inflation. Price level is nominal, whereas inflation is a rate of change. So always make that distinction. But as I said, in line with this, the key thematic issue is going to be interest rate cuts. Whether they get brought forward more and more between, I guess now and January remains to be seen. But there's been a drastic shift in the interest rate pricing curve from the end of next year to basically Q2 of 2024. So it's shifted rapidly. That could be cause for concern, or it could just mean that central banks are now happy with where we are and they might have overcooked the interest rate hike story a little bit. We will see. But thank you for joining me every day so far. And I'm really, really looking forward to 2024 and speaking to you again.